Welcome to another deep dive. Today we're looking at Twilio. Their tech powers so much of how companies talk to you. They just reported Q2 2025 earnings, and it's a bit of a head-scratcher. Strong results, but the guidance,
Yeah.
well, it spooked the market a bit.
It did. So we've got their financial presentation, the earnings release, and an investing.com analysis. Our goal is to pull out what really matters for you, the educated investor trying to decode these numbers and, what they signal.
Right. So how good was Q2 really? Where are they pointing next? And what are the details you really need to grasp? Let's get into it. Okay, Q2 2025, the results. They reported total revenue of $1.228 billion. That's up 13% year over year, reported and organic. Pretty solid top line, wouldn't you say?
Absolutely. 13% is strong growth at their scale. But what's maybe even more striking is the profitability story.
Yeah.
GAAP income from operations, it swung positive. $37 million. That's a huge improvement, like $56 million, better than the loss they had the same time last year.
Right, GAAP being the standard accounting rules. And then there's the non-GAAP view, which companies often use to show ongoing performance. Non-GAAP income from operations hit $221 million. That's up 26% year over year.
Exactly. And maybe even more compelling for you is the free cash flow. That grew 33% year over year, landed at $263 million.
33%. Wow.
Yeah, with a 21% free cash flow margin, that's, a really strong sign they're turning revenue into actual cash efficiently.
The CEO, Kazima Shipchandler, basically said the same. Called it another quarter of accelerating revenue growth and record non-GAAP income and free cash flow. Ties into their strategy, right? Being that infrastructure layer using comms, data, AI. And on the bottom line, non-GAAP diluted EPS came in at $1.19. That beat the analyst consensus, which was around $1.05, I believe. So a clear beat for Q2 on their preferred metrics.
Okay, so strong Q2 by those measures. Now let's look under the hood. Twilio has two main parts, communications and segment. How do they each perform? Yeah, this breakdown is important for you to understand the dynamics. Communications, that's their big core business. It brought in $1.153 billion in revenue. That's up 14% year over year, reported and organic. So strong growth there. Non-GAAP gross margin was 49.2%, and it generated $281 million in non-GAAP operating income. It's clearly the workhorse.
And they highlighted some big wins there, too, like a deal with a fintech for automating customer care, a huge multi-year email deal. They're also pushing AI, like using Flex with Agent Copilot for a retailer. So AI isn't just talk, it's in their products.
Definitely. Now compare that to Segment, their customer data platform. Revenue was $75 million, flat year over year.
Flat, right.
And its dollar-based net expansion rate, the DBNER, was 95%.
Meaning existing customers fed a bit less, right? 5% less on average.
Exactly. It's just some contraction or churn there. But its non-GAAP gross margin was way higher, 74.3%. It still contributed about $6 million to non-GAAP operating income.
So communications drives the growth, but Segment, even though it's flat, has really rich margins. Interesting contrast. They mentioned Segment wins, too, focused on data, like JustFab using it for ads, Centerfield for personalization.
It presents a strategic question, doesn't it? What's the long-term play for Segment? Keep it for the data angle, or focus purely on the communications growth engine?
Yeah, something for you to think about regarding their focus. What about overall customer numbers?
They reported over 349,000 active customer accounts, but, and this is crucial, they explicitly said this metric is now less informative.
Less informative, why?
Because of a large number of low-spend accounts skewing the total, it's quite candid of them to point that out.
That is candid. So that raw number maybe isn't the best indicator of health then.
Probably not as good as other metrics, like the overall dollar-based net expansion rate for the whole company. That was 108%.
Okay, 108%. So existing customers are spending more overall, 8% more year over year. That's up from 102% last year. A better sign.
It is. It shows they are successfully getting more revenue from their current base, which is generally more efficient than acquiring new customers.
All right, let's switch gears to the outlook. The guidance, what are they projecting for Q3 and the rest of 2025? This is where the market reaction got interesting.
Right. For Q3, they guided total reported revenue between $1.245 billion and $1.255 billion. That implies 10% to 11% year-over-year growth. And that revenue guidance actually beat what analysts were expecting.
Okay, revenue guidance looks good. So far, so good.
Yep.
But then, the earnings guidance.
Exactly. Here's the twist. Non-GAAP diluted EPS guidance for Q3 came in between $1 and $1.06. Analysts were looking for something more like $1.15, so a miss on the bottom line guidance for the next quarter.
And that's what investing.com pointed to as the reason the shares dropped over 3% after hours, right?
Yeah.
Despite the Q2 beat and the solid revenue outlook.
Precisely, that divergence. Strong past performance, okay revenue future, but near-term profit outlook disappoints. The market clearly focused on that EPS miss.
So what about the full year? Did that Q3 softness translate to the full year outlook?
Interestingly, no. They actually raised their full year 2025 organic revenue growth target. Now 9% to 10%, up from 7.5% to 8.5% before. They also initiated a total reported revenue growth target for the year of 10% to 11%. So more optimism on full year revenue.
And cash flow, did they adjust that?
Yes, also raised. The full year free cash flow target is now $875 million to $900 million. That's a bump up from the previous range. And they reiterated their non-GAAP income from operations target for the year at $850 million to $875 million.
Okay, so Q3 EPS looks a bit weak compared to expectations, but the full year view on revenue, cash flow, and operating income seems stronger.
It does. It suggests maybe increased investment or some cost pressure expected specifically in Q3, but overall confidence for the year remains, or it has even increased. They also highlighted their share buyback. They bought back about $177 million worth of stock in Q2. That program runs until the end of 2027, showing a commitment to returning capital.
Now, digging into these numbers, especially for you as an investor, there's always context. How these figures are presented matters.
Absolutely. First, remember, these presentations are full of forward-looking statements. They come with risks, uncertainties, they aren't guarantees. And second, as we've been discussing, many key metrics, organic revenue, non-GAAP profit, free cash flow, these are non-GAAP financial measures.
Right, not the standard accounting rules. Why do they use them so prominently then?
Well, the company says they use them internally for planning, evaluating operations, and for comparability, period over period and with other companies. But here's a critical point for you. They often can't provide the forward-looking GAAP equivalent numbers or the reconciliation back to GAAP without unreasonable effort.
Why not?
Mainly because things like future stock-based compensation costs are hard to predict accurately. But it means those non-GAAP guidance numbers you see could end up looking quite different when the actual GAAP results come out if those excluded items change significantly. It adds a layer of uncertainty.
That's a really important nuance. And what about those operational metrics? Active customers, DBNER.
Similar caveats, really. They rely on internal calculations, internal assumptions. They haven't been independently checked. And as Twilio themselves admitted with the active customer count, the usefulness of some metrics can change over time or be less informative than they first appear.
So you need to take them with a grain of salt, basically. Understand the definition and the company's own commentary around them.
Exactly. Treat them as helpful indicators, but be aware of the limitations and the lack of standardization across the industry. It requires a critical eye from you.
Okay, so let's try and synthesize this. What's the big picture takeaway? Twilio had a strong Q2. Revenue growth was solid. Profitability improved significantly. Free cash flow was impressive. The core communication segment is humming along, and AI is being integrated. The overall DBNER at 108% also looks healthy, suggesting existing customers are sticking around and spending more.
But that Q3 non-GAAP EPS guidance fell short of expectations. And despite the good Q2 and decent revenue outlook, that miss seemed to be what the market latched onto initially. It really underscores how crucial not just past results are, but also management's future signals, especially around profitability in the current environment. And understanding the non-GAAP adjustments is key.
So for you, the investor, it's about looking past just the headlines. You've got to consider the segment performance, the communications versus segment story. Understand the non-GAAP metrics and their limitations. Read the company's own notes, like the one about active customers. It's about the how and the why, not just the what's.
Which brings us to a final question for you to think about. Given the solid Q2, the raised full-year guidance on revenue and cash flow, how much weight should you really give that Q3 non-GAAP EPS guidance miss? Is it a sign of a short-term blip, maybe necessary investments, or does it signal a more fundamental challenge for Twilio in balancing growth ambitions with consistent near-term profitability that the market now seems to demand? How does that affect your long-term view?
A great question indeed. Something to chew on. That wraps up this deep dive on Twilio's earnings. Until next time, keep digging.